Alright, so we continue with the allowance method. The allowance method says we take two steps in terms of estimate and then actually write off bad debt. The first step, as we have seen, we made an end of period adjustment on January 31st to record the estimated bad debts in the period when credit sales occur. That's very important to match the expense with the revenue in the same period. And second, in the following period, remove specific customer balances or write off customer balances when they are known to be uncollectible. So we're going to look at a series of examples to see how do we use this allowance method. So here, first step, adjust for estimated bad debts. Let's say on January 1st, we record a credit sales of $120,000. So debit, accounts receivable, $120,000. Credit, sales revenue, $120,000. So that's very clear. Then at the end of the period, which is January, we made an adjustment. We say debit, bad debt expense, $900. That's an estimated number. Again, we're going to look at how to come up with the number of 900. But here, assume after our method, we know we have an estimated number. So, and then on the credit side, remember we introduced a new contra asset account. The allowance for doubtful accounts, that's 900. And then blue entries goes on what? The balance sheet. Red ones goes on the income statement. Yes. So on the balance sheet, for the period at January 31st, we have cash, accounts receivable, allowance for doubtful accounts. So you notice here that the numbers are different because remember the balance sheet reflects the total or the ending balance of those accounts. So apparently there's more than one credit sales, and then there's more than one journal entries for allowance for doubtful accounts. So, but if we look at the balance sheet, the receivable, gross receivable is $200,000, and then the contra account, the allowance for doubtful accounts is $15,000. So we have a net accounts receivable of $185,000. On the income statement, we have a total revenue of $120,000. And then we have cost of goods sold, that's fine. We have gross profit, the difference is $50,000. We have salaries and wages expense, $44,000. And then we recognize a bad debt expense here for $900, so from here. And then income from operations, $4,500. So that's the first step. Recognize bad debt expense in the period when the credit sales occurred. Step 2. To analyze this further from a journal entry perspective, we analyze and then we recognize the bad debt expense in the same period, debit, bad debt expense, credit, allowance for doubtful accounts. Step 2, actually write off customer balances when it becomes known that the customer is not going to be able to pay its account. So our company, the VFC, writes off $800 receivable from this customer because the company could not pay its account. So analysis, we're going to write off accounts receivable $800. We also reduce allowance for doubtful accounts for $800. So when we record this, we say debit allowance for doubtful accounts $800, which effectively reduced the balance of allowance for doubtful accounts. And similarly, for the accounts receivable, we also write off $800 from accounts receivable. But here I have a question for you. What about the net accounts receivable? Remember here, if we go back to the balance sheet as at January 31st, the accounts receivable net of allowance is the difference between accounts receivable and allowance for doubtful accounts. Think about it. If the accounts receivable account reduced by the same amount as allowance for doubtful accounts is reduced, say both $20,000, $200,000, and $15,000, those numbers, if they both reduce by the same $1,000, then in fact the accounts receivable net of allowance remain the same, right? So here 200K minus 15K equals 185K. If both reduce by 1,000, just to simplify the calculation, then 199K minus 14K, we're going to get the same 185. So the net remains the same. Okay, so keep that in mind. That's the second step. Allowance for doubtful accounts, accounts receivable, both reduced by $800, but the net effect of this journal entry does not affect the net accounts receivable. So that's the first part of this second step of write off customer balance. The first part is to recognize by reducing allowance for doubtful accounts and also reducing accounts receivable. But another side of the bad debt allowance we already did was in step 1 when we recognized estimated bad debt expense at 900 and increased the allowance for doubtful accounts by 900. So if we put the two steps as related to allowance for doubtful accounts and bad debt expense and accounts receivable together, we're going to look at the net effect of the two steps here. So when we look at the bad debt expense, we realize that the ending balance for bad debt expense is 900, right? And then allowance for doubtful accounts, in step 1, we increased the allowance by $900. In step 2, we reduced the allowance by $800. So the net effect of the two steps, based on the numbers in this example, on the allowance for doubtful accounts is $100, right? $900 increase, $800 decrease, so the net impact is $100 increase. Alright, so next we're going to look at the methods for estimating bad debts. There are two accepted methods for estimating the bad debts in a given period. The first one is the percent of credit sales method. The second one is aging of accounts receivable method. As you can see here, the first one is relatively easier to apply, and it is based on your credit sales or credit sales revenue. As a result, this method sometimes is called an income statement method. And the second method, aging of accounts receivable method, accounts receivable is what? It's an asset, so it's on the balance sheet. So aging of accounts receivable method is oftentimes called what? Yes, a balance sheet method. So let's look at the percentage of credit sales method first. Remember, this is one of the methods. It's based on credit sales or credit sales revenue, so that's an income statement method. So let's see what it has to say. Okay. So this method estimates bad debt expense by multiplying the historical percentage of bad debt losses by the current period's credit sales. So to get the estimated bad debt expense using the percentage of credit sales method, we need two pieces of information. First of all, we need credit sales of this month or this period, which is given $120,000. We also need a percentage, which is an historical percentage, is an estimated percentage of bad debt loss rate. So we look at historical data, the previous month, the months before the previous month, the last 12 months, and then we have an average. So that's one way or one method to do it. So here we say that's 0.75%. That's our estimated bad debt loss rate. So we have credit sales this month times bad debt loss rate. We get bad debt expense of this month. Estimated expense is $900. So go back to our example. VFC has experienced bad debt loss of 0.75% of credit sales in previous periods. Credit sales in January totaled $120,000. So credit sales this month is $120,000 times bad debt loss rate of 0.75%. So that's 0.0075. We get $900 of this month's bad debt expense. So in step 1, by the end of this month, before January 31st, when you say debit, bad debt expense, credit, what? Allowance for doubtful accounts, $900. Okay, so actually that's the, so this is a journal entry, bad debt expense, and then allowance for doubtful accounts. I'm going to stop here. So next we're going to look at the aging of accounts receivable method. But in this part 2 of my lecture of this chapter, we look at the allowance method, which is take 2 steps. First step, estimate and record bad debt expense in the same period as the credit sales occurred. And second step, when bad debt actually happened, we just adjust the account receivable and allowance for doubtful accounts. Those 2 accounts, we do not adjust or affect the income statement. And then we look at the percentage method, the percentage of credit sales method, which is based on the income statement, based on the credit sales of this month, and based on estimated bad debt loss rate.